All right, let's get her going. Let's see. All right, welcome to Wall Street Beats. It is amazingly February 11th, almost Valentine's Day. I am Benjamin Bry. This is Robert Marson, Bob Morris. Bob Morris with a little smile on his face, oil creeping back up for him. Um, let's start with you, Bob. What are we talking about today? We talking about a little excitement in the patch?
Well, we got oil back up here above $65 a barrel, which is huge for these energy stocks and the energy sector, especially given some of this rotation into industrials and hard asset type companies following what was not a boom year for energy last year with oil prices down on the year in 2025. But there was a lot of pessimism and bearishness around crude oil prices coming into 2026, just given the projected oversupply in the market that a lot of people saw. That's tightened up a little bit here. But at the same time, what's come to the forefront are these tensions with Iran and how that plays out. And right now, it is sort of touch and go, and the U.S. is building up forces in the Gulf over there. And we don't know if they're going to come to the table and really negotiate a deal that the Trump administration wants, or if the Trump administration is going to take military action. We've got the Netanyahu over here in the U.S. today meeting with Trump and laying out his case as to what to do, and we'll see what happens here. But that's got oil up here above $65 a barrel, because if there is some military interaction or response from Iran that interrupts the flow of crude oil out of Iran, that's huge. That's bullish. So it's, again, we've said all year that it's the headlines around all these events that are driving the oil price, and that's despite what was really a somewhat bearish U.S. crude oil inventory report yesterday. So, the stocks are moving up sharply here as investors look to sectors that maybe underperformed last year that are rotating into with good hard assets, with $65 oil being a very good price for the bottom line margins and profits for these companies. Other than that, you're looking at natural gas prices here. They're down just above $3, which is because we're coming out of the winter and we've got storage levels still above a year ago. So, natural gas prices a little bit punk here. But one thing I want to touch on too is we mentioned last week that Williams was having their analyst day and earnings yesterday, and I thought that was all very positive. Net for the quarter, EBITDA came in a little bit ahead of expectations, but the analyst day sort of centered around the company focusing on really wanting to be a one-stop shop for this data center power demand. And so they really want to be at the forefront of being the premier player, providing all the power and resources for all these data centers for AI going forward, which I think, the market looked at positively. And the one thing they said that was interesting is that they'd like to have more natural gas assets. Right now, they're mainly a pipeline infrastructure, LNG export company, but they indicated that they would like to own natural gas assets. And, I'll touch on another favorite company in that regard, and I'm just speaking to speculation and rumors, but Expand Energy on Monday, they announced they were moving their headquarters to Houston, and I don't know if you saw it, Ben, but their CEO Nick Delasso abruptly resigned, and I don't think it's because he didn't want to move to Houston. I think there was some difference of opinion on the strategy for the company going forward between him and the board. And that's just my guess or my speculation. But I know that Nick was very adamant about being a pure play natural gas player. They're the largest natural gas producer in the U.S. And his clear vision was that they remain a pure U.S. natural gas producer. So, there are rumors out there as to why he left, but I think the bottom line, the stock took a little bit of a hit that day. I think it was down 6% on his departure. They've got an interim CEO and they're searching for a permanent CEO, but it doesn't deter my view of the company. I don't think there's anything internally going on there that we should be concerned about. I think Nick just stepped down because he had a different difference of opinion with the board on the strategic vision for the company going forward. But other than that, yeah, I mean, Williams reiterated my view on them of a core holding in the portfolio here. And otherwise, with these oil prices, the stocks we like are working. I got Chevron here. Coming into the year, my price target on Chevron was 180. We're above that, so I got to revisit that. And with the view with where oil prices here today, see where we go with that price target. C&Q up here pushing $40 a share. All these names have had a great move year to date, and I'm not doing anything. I'm sticking with them. I'm not selling anything. I'm not at the same time. The only thing I bought recently, as I mentioned last week, was some Devon, following on their merger with Coterra Energy. But I'm holding on to my other names, and as you said, very happy watching what oil prices are doing here. And we'll watch the headlines. If it comes out tomorrow that all's good with Iran and we've got a peace deal and they're going to do what we want, oil prices could pull back here. But I don't think that's going to be the case. I think it's going to be a very difficult road. I think it's going to be very difficult negotiations. And I don't expect that you're going to see a headline anytime soon that all's good and we're buddies and friends with Iran and they're not going to enrich uranium. They're not going to have nuclear facilities and they're going to cave to all the things that the Trump administration wants.
Yeah, I'm just looking at this Chevron chart right now. What a year! What a year!
Chevron's
might be your year, Bob.
fire. Yeah. I mean, we reiterated coming into the year. Our top picks this year were Chevron, C&Q, and Expand Energy. So, Chevron's just been a horse here, and they're longer term. They benefit from things opening up in Venezuela, which has been an added tailwind for them.
Yeah, I was actually looking at the chart of the EWI, which is the ETF for the South Korean Kospi Index, up and to the right, on this whole memory thing. And then I pulled up your Chevron. Looks just the same, just up and to the right. It's a new era.
Yeah.
All right, so you're kind of sticking with what you like, riding it. I mean, I saw yesterday U.S. oil production down for the first time since COVID, basically. Did you see that chart? Or did you see that data?
Yeah, I think some of that was just shut-ins from the storm.
Okay.
Yeah,
which makes sense.
The chart the week before showed it up, I think 3.4% year over year. So it's continued to creep up here. I don't think anybody's backing off. We had a lot of shut-ins and interruptions from that storm a few weeks ago.
Yeah, and so I guess my point is do you see production growth from this, the U.S. as a swing producer stalling out here? There's a lot of people who are saying that might happen. I mean, if it does, then we have a huge different dynamic on our hands. Or you're just saying that's just a one-off?
I think that's the one-off. I mean, stalling, everybody's been saying it's going to stall. I mean, you're up, from 13.1 to 13.3 million barrels a day. I mean, it's going to be relatively flat. When you say stall, it's sort of just been creeping up here just because of efficiency gains and improvements. And, you look at somebody like Chevron, they're going to hold the Permian at 1 million barrels a day. They're going to hold the Bakken flat at 200,000 barrels a day. So most companies are not looking to grow production, but there's going to be some creep up just from efficiency gains and better well performance.
Okay. All right. Let's move on to Robert. Robert, you got any thoughts on energy here? Since you're kind of an energy guy.
Sure. I hope the next $10 a barrel in oil prices is up because it's much more fun if it goes to 75 than 55. That's my real comment. But I don't know what it's going to be. If I had to guess, I don't know what I would pick, 55 or 75. It's an interesting question.
I mean, it's largely somewhat of a guess because you can't predict all these headlines and you've got headlines going both directions. You've got inventories and prospect of Venezuela ramping back up is bearish signal, but on the other hand, you've got bullish signals from the tensions with Iran and whatever happens between Russia and Ukraine could impact oil prices if peace breaks out there and we lift sanctions on Russia. And in the meantime, we're trying to clamp down on Russia and force India not to buy oil from them. And so there are all kinds of factors going on here, crosswinds that it's hard to gauge what the outcome is from all these crosswinds.
Right. I
Yeah,
did see a
slumbers.
chart. I did see a chart yesterday that was quite interesting. I was on a Zoom call with some colleagues of mine, former colleagues, and we do a Monday lunch meeting every week. And the chart showed that non-OPEC oil production is forecasted to actually roll over and decline starting next year or 28 because there's not been a lot of investment and we're sort of absorbing this Guyana, spike in production,
Yeah.
off the eastern coast of South America. There's some fields that are getting, put into service that are fairly large. But
Yeah.
this was an oil consulting firm, and the demand, global demand, even with the rise of EVs, has continued to creep up. Whatever it is, it's not a
Hmm.
lot, but it's not
Hmm.
negative either. I don't know if it's what 100. It's 100. It's a low 100 million barrel a day number, I guess. Right,
Yes.
Bob?
Right.
So if non-OPEC starts to flatten out globally and or roll over and start to decline slightly, and OPEC is just keeping production flat according to this consultant, then the market in 12 to 18 months gets considerably tighter. I don't know if he has China's 2 million barrels a day strategic reserve filling in his demand numbers, because that's sort of a wild card swing factor. They seem to be buying a lot more in the last couple of years than they're consuming. So
Yes.
I'd have to look into that because that would
Yeah.
definitely change the numbers by 2 million barrels. So
Yeah.
I'm
That's been a
assuming
big
it.
factor, and that'll continue this year. But we don't know. We get no data on that, so we don't know for how long they'll continue to fill that SPR there.
Right. But assuming that continues into 27, 28, then, the market actually gets into a slight deficit according to this guy. And he thinks,
Yes.
he would definitely argue that the next $10 is up, not down. So assuming the global macroeconomic situation holds together,
From
right?
yeah,
That's
looking further out, I would agree. Yes.
yes. So on my energy company, I've mentioned this in the past, and I've told people that I've owned it, and I'm actually finally changing my opinion on one of my larger positions. It's enterprise products. It's a high quality, low leveraged, natural gas and natural gas liquids play. They even have a specialty chemical business in there, and it's sort of gotten to be where if I were looking for a source of funds, I would trim stock or sell stock. It's up to 35, 36. It's at a close to a 10-year high. It's 10 times EBITDA, maybe a little more, maybe 11 now. They announced that they were going to have a flat year this year in EBITDA. What got the stock up to it popped 10% after the earnings release was their forecast that, yeah, this year's going to be low single digit EBITDA growth after low single digit EBITDA growth last year, but next year will be over 10% organic growth. And that's a pretty big number for one of these MLPs or pipelines. So that got people the outlook for 26 was so uninspiring that they gave a 27 outlook and they gave a very strong 27 outlook. And, that's good for a short term move in the stock. But I think the dividends down to about 6.5% yield. The growth rate is low to mid single digits, 3-4%. I think they're making a strategic mistake in keeping the coverage ratio at 1.7, 1.8%. I believe these businesses should run 1.5 or lower. So their payout ratios should be much higher. So they don't need excess dividend coverage. They're just putting money into growth capital spending, and they kind of don't get paid for that in the long run, in my opinion, because no one owns them for growth. People really own them if they can grow 5, 6, 7%. I think that's pretty good. And as long as they can do that with a significant payout. So they're being they're being too stingy with the dividend increases, in my opinion. So if gun to my head, the old comment we make, gun to your head when you buy or sell one of your positions, and you had to make a trade, you couldn't say hold. I would actually sell the stock here rather than buy it. And that's like, one of my top three positions in my portfolio. It's gotten fairly priced, has a 6.5% dividend yield, growing 3%. I can't get excited about that. When I bought it, it was in the teens, and I had a double-digit dividend yield, which is now about a 12% dividend yield, cash on cash. So, if anybody out there has that, and that's how I'm thinking about this position. It's in my income portfolio, and I probably won't sell it aggressively, if at all. But it's a situation where I definitely believe it's fairly priced and wouldn't be buying up here. So that's my opinion on my internet. It doesn't have a lot of oil, leverage to oil prices or natural gas prices. It has some because these are fee-based, businesses, as are most pipelines. So I talked about Intest a couple of weeks ago when I was buying it in the $7 and $8 range, probably 3 times since last spring. INTT. It's a little electronic testing company, makes products that test circuit boards and go into semiconductor testing and all that. Unfortunately, they're more analog in power, and they don't have memory and logic or GPUs or CPUs. So they've not been booming. But there's been a sea change in how the stock market looks at analog semiconductor companies. TI had mediocre numbers, stock soared, on semi missed, stock was up a lot. All the analog related peer companies like Cohu, COHU, or Cohu's a very good lead indicator for Intest. COHU, it's one of their biggest customers in the semi business, and it's breaking out. It's more than doubled off its bottom last year. Intest bottomed at 6 and it's 10, and the old high 2-3 years ago was $25. So if I didn't have any Intest, and I have a nice position because I bought it a few times in the last 6 months, 9 months. The stock market is now starting to pay for a resumption in the non-memory, non-GPU, CPU part of the semiconductor industry. And this company trades at 1-time sales. The peers are 2.5 to 3. They actually have a peer that's 10-time sales. So it's called AIR, AEHR is the ticker. So it just seems to me to be a layup when you have improving fundamentals, significant turnaround in the business. Your peers trade at 3 times your valuation, and the stock prices are way ahead of your own stock. To me, that's when I press my long position. And INTT is the ticker. So if the stock market is right on sniffing out this upcycle for analog, mixed signal, power, industrial semiconductors, Intest, should be. I've already said here it should be $15 by the end of the year if they're making 80 cents to a dollar run rate, 20-cent quarter by 20 to 25-cent quarter in December. So the stock should be much higher than $10. So that's a current position that, if forced to buy or sell, I would absolutely buy, even though my position is up about 40% in like 3-4 months. It's still not too late, in my opinion, for that one. And then lastly, I put a new company into the Circle file, do work. Ben, I talked about PayPal yesterday, which is in the do more work on and sniff around file. And I put DocuSign in the same folder. So DocuSign, has this. It's gotten crushed. Is it AI vulnerable or not? There's a lot of fear. It's the stock. Peaked 10 years ago, same price it was 10 years ago. A lot of these companies that have software-related products and services are down a lot, and they're not just SaaS companies. They're other types of businesses. So the stock is trading for a low valuation. They're buying back stock. There's a lot of free cash flow. They created their own AI-driven light DocuSign document signing product called Intelligent Agreement Management. It's very easy to sign up for and implement. It's AI-driven. So Their new customers are onboarding in droves, but they're low volume, low usage, low dollar value customers. But they are soaring. They're starting to really ramp. So if DocuSign could turn AI into a benefit instead of of it cannibalizing its business in a major way, the stock could turn into a good stock. So I'm sniffing around to see if there's. I think there's companies that are going to be using AI productively to increase and enhance their services and their capabilities. And I'm not sure that AI prompting is going to create all kinds of disruption in the software and services business in the very short run. But I wouldn't buy SaaS companies. And as I said over a year ago, when Klarna turned off its Workday and CRM because it had created its own internal capabilities. I still think there's too much, risk for me in that business. But if you can get around peripheral businesses that are not directly SaaS related and being targeted by the AI, LLM companies, then I think you have a chance of hitting some winners. So that's why I'm interested in owning SimilarWeb and looking for companies that have been, sort of painted with the same negative brush.
All right, that's good. I'll just make a little comment as the resident macroeconomic guy. This NFP beat was just kind of a headline beat. Most of this was from healthcare, and you saw big downward revisions for 2025. 1.05 million jobs revised down. That means last year we only did 15,000 jobs per month on average. Market's given back the entire pop off the headline beat this morning, and now the IWM's down 1.3%, and I'm short the KRE with our colleague Charlie. That's down 50, 60 bips, and so I don't think what the headline was and what the under the surface was is a little bit different thing. So just wanted to add that. Plus, I do want to pump that the Schlumberger boys is at 51. I love that.
Mm-hmm. Yep. That's another good one. Another first service name we've owned in a long time. So yes.
Yeah. There's something that I think that especially in this group, Robert and I, speaking of, I also agree with Robert that the PayPal seems like something that's interesting to look at when you think about the fact they're going to buy back 10%, 12% of the company in stock, and then so let's say that's 25% of the stock. That gets you to about a $30 stock on a forward two basis if it doesn't move at all. And they earn $6 a share in free cash flow. Now that could go down, but just saying, you're at like kind of an adjusted 20% free cash flow yield. They have the potential to become a bank. They have that catalyst out there that they've applied for that. They have 425 million users, versus just reference of JP Morgan is 75. So they can convert some of them. There could be significant net interest income that could drive, some earnings growth. And when it was a high multiple stock, I could see why you would argue against it because bank is much more capital heavy. So your ROI is going to go down. But now this is not a high multiple stock anymore. This is now in what Robert and I might refer to as in the dog camp.
This is super deep value right now.
Yes.
Unless the business shrinks, you'll make money in the stock. My only, I've become more of a growth oriented manager over the last 5-6 years, and if they sandbag growth rate at 5% and deliver 9%, I'd be excited. But they sandbag their growth rate with their new CEO to 0 growth rate, right? Or negative single digits. So, and then maybe they do low single positive digit sales growth if they participate. They've been losing a lot of share lately, and they need to fix the company. And I would think the CEO sandbagged pretty significantly. He was a board member, and he was brought on, and his the current lead outside director said that they consulted with him when they set their expectations for this year in his conference call. So even before he was hired. So you know the routine when a company replaces a poor performing CEO, the incoming CEO normally sandbags the numbers. so that he looks good and beat and raise. Places all the blame on the estimate cuts on the outgoing CEO.
That is the way the
So,
game is played. I mean, historically.
yes,
All right. We got anything else, boys?
that's it.
I think that's it.
Right.
I think we'll keep it tight this morning. All right. Well, I'm Ben Bry. That's Bob Morris, Robert Marson. We are out of here. We'll see you tomorrow with Wall Street Beats.
Thank you. Thanks, guys.
Thank you. Bye.